this particular module just going to show you the people who own houses for many years, whether you are a primary homeowner or whether you are a long-term real estate investors that you and I help with. This is our business model, by the way. Even home buyers and investors that purchased 2 or 3 years ago, they have achieved massive amount of wealth and equity. And this slideshow is an indication of that. Let me quickly go over the highlights of this slideshow. Sellers, as you and I alluded to, have locked in to a historical low mortgage because they're not going to sell their homes to move up to buy a 6.5% mortgage rate, essentially doubling their payments. They're not going to do that, so they're going to sit tight. 9 out of 10 mortgages have a mortgage interest rate below 5%. More than 40% of all homeowners don't even have a mortgage. Furthermore, look at the breakdown of this type of mortgage holders. They are sitting on a gold mine.
50% of the people that have mortgages under 3.5%. That's crazy. And 70% have mortgages under 4%. The Fed messed up.
Yeah. For those of us that overcame fear and bought primary homes in the past, and for investors that bought cash flow homes through you and I, collectively, they are sitting pretty. They're sitting in a gold mine. I don't want to bash the renters out there afraid they pull the trigger. It's a breakdown. Look, almost 5 million people with a mortgage of less than 2.5%. This is mind-boggling. This is beyond historic. Let me go over a practical scenario where you and I will consult our turnkey real estate investors to buy in a good affordable market. Here's a scenario I want to share. A handful of my members 2 years ago and prior have purchased rental properties outside Austin, in Central Texas, and in Central Florida, and in Southwest Florida, Cape Coral region. They purchased their homes, 3-bedroom, 2-bath, like 2 years ago in 2021 for like $250,000, $300K. A lot of them, their home prices have increased 40, 50, 60, even 70% appreciation in a mere 1.5 years from today. The question is, here's the assumption I want you to go through. For investors who have rental properties who already purchased a 25% down payment 2 years ago, and they have achieved additional 40, 50, 60% equity appreciation, should they take out a HELOC loan, pros and cons, or should they do a cash out refinance? You, as a mortgage broker, do the pros and cons of that. And also, some investors have massive amount of equity from their principal home. Should they take out a HELOC or a cash out refinance to buy more properties, to buy more rentals, and where and what to buy? You and I know that already. But before we go any further, I'm not sure whether I'm correct or not. It's very difficult to take out a HELOC, home equity line credit, from a rental property. I believe some lender may have opened up this product. Once again, I'm not sure whether you are doing it or not. Regardless, I want you to discuss that and all the things that I just shared with you. With that in mind, what are your thoughts?
We offer equity lines to investors and primary home buyers. As you can imagine, the equity lines are based off of the Fed rate and the prime rate, right? And we keep saying how mortgages, fixed mortgages aren't. Equity lines are. Those interest rates right now on secured revolving debt like equity lines are double-digit % most of the time, especially on investment properties. Primary homes, keep in mind that first mortgages are at 6.5%. Equity lines are same thing, 9.5+%. So does it make sense to leverage your home via an equity line or redeploy it into additional properties given how high rates are? It's not about opinions, right? It's about numbers at that point. So I encourage you to run the numbers, see what cash flow you're going to generate from a new purchase. It is a good way to put the stagnant equity that's in your primary home or in a rental to work without having to sell it. But at the end of the day, once again, we need to run the numbers to see what everything looks like. The payments can be quite high at those double-digit interest rate wise. Definitely something to factor in, but it could be a huge part of strategy in terms of growing your portfolio, right? A lot of us have a good amount of equity in our rental properties or in our primary homes. So they are a good tool to have, or at least to open up and keep it as an emergency fund. Typically, your equity lines are like credit cards, so you're not going to really pay anything unless you retain a balance. So it is a good security blanket to have, and depending on your situation, it may or may not make sense to utilize that as an investment tool.
Yeah, Richard, the other part of the argument is that somebody might say, look, on my primary home, I'm locked in at 3%, 30 fixed rate mortgage. I'm not going to touch the interest rate, so I'm not willing to take a risk to put equity out of my primary home to buy cash flow, rental properties, whatever. But then another position I want to make a counter argument is that a rental property, even though a lot of our investors who bought 2 years ago, rental properties as well have 3.5% mortgage rate. As a rental property, you should willing to take more risk. It's okay to catch a refinance, get rid of 3.5 rate mortgage on a rental property, especially if we can buy some good cash flow properties and have the cash flow to pay off the loan payments accordingly. So everybody have a different risk tolerance. The chart we just shared, the trillions of dollars of equity. You and I know most people are not investors. They are primary home buyers only. They have no clue. They don't care about buying rental properties. That's fine. They could lock in the mortgage rate for the rest of their lives at 3% or less. And when they die, they just pass on their free and clear home to their loved ones. And that's the majority of the people out there own primary home. But you and I are in the investment space. With that said, so look at that risk and reward or go over the assumptions we just made. Go ahead, continue with your analysis.
I agree with what you said. It's going to vary for each person, but also you have a low rate first. It does leave you a little room to get aggressive, but it's about the numbers, right? So if you're going to leverage your home and including servicing that payment, including buying the new property, you're actually better your financial position. You diversify your assets, but you actually maintain or increase cash flow. I think it's a good investment, right? Even if you maintain cash flow and don't necessarily have an increase, but you could buy a new property for no money out of pocket, even if you're not making a huge cash flow on it. All you're doing is diversifying the equity you have in that primary home. I think it's definitely a good strategy, especially because in the long term, real estate's going to go nowhere, but it's a supply and demand issue. It's not going to get solved anytime soon, if not ever, right? People are living longer, advances in healthcare, the world population keeps increasing, and land is not increasing. It's just a common sense approach.
Yeah, Richard, I think furthermore, my take is this. That's why what you do and what I do is as a team is very important. Okay, let's assume that an investor want to do a cash out refinance, either their rental property or their primary home, or do a HELOC. Whatever the case may be, it's important for them to consult you as a mortgage loan officer because you can understand their goals and objectives. Then you can help them run the numbers. It's so critical for an investor to run their own numbers and not consulting a reputable investment loan agent like yourself. They are doing themselves a disservice. They can waste a lot of time thinking they could run the numbers on their own. And so you are such an important person as a team in their lives of a real estate investor to scale their real estate portfolio. And myself, being an owner of a real estate investment club, I have an obligation to help investors to buy turnkey cash flow properties in good, affordable markets. So if an investor try to do it themselves, they try to buy property, cash out refinance equity, take that risk and buy in a wrong market. If they're going to buy in a market in the western region of the U.S. with home prices that the median price of prices in, don't buy in Las Vegas or Phoenix or Boise or California where the median home price are anywhere from $500 to $1 million and expect to put 25% down payment and expect the cash flow. That is, you need to buy in affordable, growing markets in the Sun Belt and even the Midwest for that matter, because you buy at a low affordable price where the cap rate is very reasonable. You can get cash flow with 25% down payment. South and Southeast Florida and Texas and a few other places in the South and Southeast are ideal for a little bit of cash flow and decent appreciation potential. And Midwest, as you and I know, you have a lot of value in the Midwest too. Midwest is doing some high cash flow properties, lower price point. So that's how you create a scale portfolio by working as a team. As we conclude this presentation, what is your takeaway and what's your recap before we conclude?
Got off the fence when we told them to get off the fence a year and a half ago. And over the course of the last year and a half, everyone would be in a very good position right now because as you're seeing and as the media is catching on to, real estate's pretty robust and it is one of the most secure, tangible investments you can really make in the long run. And I know I keep beating the horse on this, but it's supply and demand. And that's what we've tried reiterating the last year as all this media is about the doom and gloom. Set all that aside. Forget what they're saying. Forget what you and I are saying, right? Just look at common sense. You know what I mean? If there's 8 people trying to buy 2 lollipops, the person selling the lollipops is going to be able to sell them for a lot of money. And at the end of the day, there's 2 lollipops and there's 8 people trying to buy them and those lollipops are homes. And that is not going to change in the short term, no matter what external factors are thrown at it. All those factors are short term, right? Okay, the Fed increased rates. They're trying to cool housing. backfired, right? You can't cool housing when there's that big of a supply and demand issue. You just can't do it. You can pause it, which is what they did, but it's not going to completely cool down. And they've once again done the opposite. What they should have done is spent those billions of dollars towards incentivizing builders, giving them some cushion so they're not scared that what happened 12 years ago, 15 years ago is going to happen again. And guess what? All the builder incentives that we've seen, they're all still there right now. Mark my words, in 30 to 40 days, these management included or 2% seller concessions are going to go away, because as people are getting off the fence, the builders are realizing too, hey, wait a minute, it's not as bad as we thought it was going to be there. We don't need to incentivize these dramatically, right? So whoever has bought in the last year and a half that ran the opposite direction as the masses, they reaped the rewards. And in my opinion, obviously probably a little premature by a lot of the builders, but they didn't want to sit on inventory, right? There's price reductions, builder incentives, all this crazy money going to people who were thinking rationally. There's still strong fundamentals for real estate. They're all going to reap rewards, because regardless of values going up, values going down, you lose a 2% seller concession, you do lose these other benefits. That's 20, 30 grand in savings of their home that a month from now or 2 months from now, when those are gone, someone else is going to be paying. The biggest thing I would say is for this situation and moving forward, it's important to gather data to make an informed decision, but gather that data. Don't read the headlines. Use your own common sense on determining whether something makes sense or not without all the noise, right? Because now I tell people like supply and demand, and we have a conversation like, oh yeah, that makes perfect sense. So I didn't think about that. Now you're willing to hear that because a lot of the fear mongering and doom and gloom is gone, right? But if you would have realized that was just noise at the beginning, you would have capitalized on it.
Richard, you're absolutely right. And my final takeaway is going back to your own personal portfolio. The video that we did over time, the past decade, you have systematically bought rental properties. Doesn't matter about the economic conditions. You dollar cost averaging your portfolio. Now you own, don't quote me, like 18 long-term rentals and 2 short-term rentals. And when I interviewed you, I asked you, what's your total time spent per month on your massive real estate portfolio? You said 1 hour, 1 hour per day. No, 1 hour per month.
And that's just because of the short-term rentals too. That's not even because my whole portfolio was long-term rentals. It would be less than that, I would say.
For sure. That's why the concept thing I've been promoting with my network, you buy turnkey out-of-state cash flow properties in good affordable markets. Surround yourself with reputable turnkey providers in those sub-markets in the South and Southeast and the Midwest. Invest over time and scale your portfolio and delegate to all the team to do all the dirty work for you, while you and I sit back and relax and spend 1 hour per month scaling, managing our portfolio so we can divert the rest of our time to achieve our lifestyle, financial freedom, whatever it is, travel or taking care of family members or having fun for years and years later. Work smart, not hard. At the end of the day, that's a rainbow. But today, you have to grind, you have to take action, get off the sideline and take action and overcome fear. And 10 years later, you will not regret it. And so that's my final takeaway. Any quick final takeaway for you, Richard?
No, I think you nailed it with that one.
Richard Advani, thank you so much. I'll let you go. We'll come back for another great video in a couple of weeks. You're very insightful. You're very motivational. I know you have multiple jobs. I don't know how you find time to sleep. I'll let you go so you can do a lot of loans for great investors. Thank you so much, Mr. Richard Advani on Guarantee Rate Mortgage. Have a nice day. This is Seewing Yee. See you next time. Bye-bye.